Hello everyone, welcome to this another interesting session on dollar INR. Okay, it is Friday, the weekend, TGIF, thank God it's Friday. So let's have a look of how rupee has been weakening, and we look at some another chart and some hedging ideas as to how do I hedge my risk in such a volatile time. Okay, so let's look at the dollar INR chart. This is the 24-hour dollar INR offshore chart. Okay, so it runs 24 hours, so there not be any price gaps. So let's look at this chart and let's try and evaluate what is the trend. Okay, it's a very clear-cut uptrend. Okay, if you look at this linear regression channel, it is following within, the prices are moving within that channel, and it's a very clear-cut uptrend. Okay, the highs are getting higher. Okay, the lows are also getting higher. Okay, very clear-cut uptrend. And if you look at the trend, if you look at the chart closely, the previous high of 87.95 was broken, and it was broken just around the end of August and September. And since then, the dollar has been posting fresh highs and rupee has been declining to new lows, fresh all-time lows. Okay, so picture is very bearish. There are all the technical indicators are pointing towards a price extreme. That doesn't seem to change. Trump is looking like solely focusing on India to impose more and more tariff. So geopolitical worries are pressurizing the rupee, and the trend doesn't seem to change. So it's a very clear-cut uptrend. Let us also look at another chart. Okay, I wanted to show something more interesting. Another chart here. This is a rebase chart of dollar INR, which is the blue line, and the Asian currencies and the dollar index. Okay, so look at the dollar index. Dollar index is the white line, and I am starting from the beginning of 25. Okay, so I am starting from the beginning of 25. So this is 2025. This is where I have started, and it is from beginning of 25 till now. So blue is the rupee. Okay, white is the dollar index. If you look at this vertical line, this is 20th of June. I had shown this chart, same chart on the 20th of June. And at that time, the dollar index was around this level. And since then till now, the dollar index is mostly similar. Okay. If you look at euro also, euro was also mostly similar, just plus minus one half or 1% above or below. All the Asian currencies, these are the Asian currencies. Okay, you can look at this legend here, the Asian currencies, the legend is given here. All the Asian currencies are sideways, but look at what has happened to dollar INR. Okay, dollar INR is going higher. What I showed you in the previous chart, rupee is continuously under pressure, despite the fact that the dollar index has moved sideways, despite the fact that most of the Asian currencies are moving sideways, and also despite the fact that Chinese yuan is also sideways. Remember, dollar INR shares a very high correlation with Chinese yuan, but this correlation is getting broken. Yuan is static, Asian currencies are static, dollar index is static, but still rupee is under pressure, and the dollar INR is continuously scaling higher. Okay, so that is the dichotomy. It continues since June when I showed it the last time. Okay, so 3 months, 3.5 months, the dichotomy is continuing. Dollar is weak, but rupee is also weak. Rupee is getting pressurized by a lot of geopolitical concerns. Okay, so in such a situation, what do I do? Okay, let me look at something which I had discussed with you around the same time when I showed that rebasing chart. During that rebasing chart, what I had indicated was that it is the ideal time to do vanilla options. Okay, so let us take an example that a month later, after 20th June, let's take around let's take a month later after I gave that analysis, around on 21st July, if I take a vanilla option for 2 months. Okay, so it will expire around the middle of September, July, August to September. If I did a vanilla option on 21st July for 2 months, and on 21st July, the spot was around 86.12, the forward rate was 86.48, and I take a strike price, ATM strike price, which is 86.48, I have to pay an option premium of 63 paisa. I just want to evaluate that if would have done a vanilla option for both exporters and importers, I'll take their case one by one. I want to evaluate how that option would have worked in the current scenario till the 19th of September, when the rate at maturity was 88.20. The rupee had weakened substantially. Okay, so in this scenario, if I would have done the option, how would it work in such a volatile scenario? So let's look at it one by one. Okay, so let's look at the exporters case first. Okay, we are looking at a dollar put. Remember, 86.48 is the strike price. I took a dollar put at 86.48. Okay, now the market has gone to 88.20. I will not exercise my put because I'm getting a much higher rate at the market. So I will ignore that 86.48 ka put and I will sell dollars at 88.20. Okay, unlike a forward where I would have got stuck here at 86.48, in an option, I have a choice. So at 88.20, I do not want to sell at 86.48. So I will ignore the option and I will sell at 88.20. Okay. And since I had paid 63 paisa premium, my net rate will be 88.20 minus 63, which is 87.57. Okay. Now just compare 87.57 with the forward rate, which I would have done that time. Okay. So my option rate is 1 rupee 9 paisa better than my forward rate. Okay. So by doing an option, an exporter would have been hugely benefited by more than 1 rupee compared to the forward rate. Okay. So this case is clear. Exporter would have benefited by doing a vanilla option. Let's look at an importer's case. Okay. Now, in an importer, you buy a call. You bought a call at 86.48. You paid a premium of 63 paisa, similar to a put. And what has happened? The market has gone to 88.20. Okay. So market has gone up substantially higher. You have a right to buy at 86.48. So you will exercise the option. Okay. You will exercise the option. Okay. You will buy at 86.48. That is this rate. But since you have paid a premium of 63 paisa, your net rate would be 87.11. Your net rate will be 87.11. Now, this will compare adversely to the forward rate because the forward would have been better. You have already hedged at a lower rate. So, your forward will perform better than the option in this case when rupee has weakened substantially. Okay. So, how has it fared? For an exporter, it has fared very well. For an importer, it has not fared well. An importer would have been better off doing a forward. Okay. But what is the conclusion? The conclusion, what I want to drive, ladies and gentlemen, is that a ideal risk management system is having a combination of forwards and options both. Never do only forwards or you never do only options. You will always do some kind of a combination of forwards with options. That is the ideal strategy. Getting that flexibility which a vanilla option gives is very, very important in such volatile times. So please look at all the videos. I have shared a lot of videos which I have explained how vanilla options are a very effective instruments. So do have a look at that. But here in this volatile time, for an exporter, option works better. For an importer, a forward works better. But obviously, no one knows the future. So a bottled mix of forwards with options is the right and ideal hedging solution. So that's it from my side. For more such insights on our currency markets, please join our WhatsApp community.